Hi, this is Randy Finney with Right Side of the Chart. This is an early session update for Monday, August 16th, 2021. What we're going to do here is go over, start out as usual with the indexes. I actually do have something new, a new technical development to report. For a while, it's been same old, nothing new to report. We grind higher, divergences build, but there's something I'll go over today very quickly. Then we'll look at just another update on credit spreads. I mentioned that on Friday, I believe it was. Quick update on the junk bond ETF holdings, and then some of my favorite trades, which are oil, natural gas, gold, and commodities. So we'll go through in that order. It will not be a long one. Starting out here with the indexes, from this perspective, just the 60-minute charts, not a whole lot to report. Well, really nothing there, but there's something else I'm going to get to. But there it is. So we have the divergences continue to build. A little bit of an impulsive, semi-impulsive drop, 0.5%. Nothing big, but in this recent period of very low volatility, that's one of the bigger moves we've seen in a while. You can see the gap down, the big red candle. Will it be the start of something? Who knows? You got to take out these levels. I think so. Well, soon, at least. I don't know if today, this week. But 441.84 roughly, and then of course I had these magenta lines here. Really, that one should seal the deal. Break below 436 right there, roughly that bottom line. So again, from a price perspective, nothing really big today to report. Nothing new there. And then 60-minute chart, QQQ, same story. We've been building the divergences. Divergences were in place at this recent high on QQQ, and should it just inch higher and take out that previous high, as long as it's only a marginal new high, we'll still have negative divergence. That won't change. It'll just extend these lines, and then again, the magenta lines really need to get taken out, I think, to start some impulsive selling to the downside, and that's 380.56 roughly. That's call it 380.50, the bottom of that. All right, so that's nothing new there. What is new is my low volume indicator. This is something I've shared on the site for many years, and I don't update it often because usually there's no signals. Volume is normal, and meaning above these lines I have down on the bottom. Two lines, and don't really should be yellow on top if you want to use yellow as caution, red as sell, but it doesn't matter. The color is not important because sometimes it's a tag of the upper line, and sometimes you can see a tag of the bottom line. It might be hard to make on the video. If I drag it, you can see here. And just to recap for those that haven't seen it, what I do is I overlay a 10-period EMA, or exponential moving average, over volume. Because if you try to extrapolate a single day volume, there's errant spikes in volume and drops in volume, holidays, things like that. And you're just going to get whipsawed to hell. So no, I don't read too much into any single day, big volume, low volume. It does help when you confirm a breakout on a chart pattern, a break of support or resistance to see volume spike. I will give you that. But as far as this indicator, I like to use the average because it shows kind of conditions. What I look for is when the market is rising, as it has been. You want to see a rise on, it doesn't have to always be advancing volume, and nor will it be. Early on in a rally, usually volume spikes. But what I look at is, especially after an extended rally, volume, again, the 10-day EMA down here to approach my sell signals. That's basically what those lines are. And again, called a zone. Sometimes it hits the top of the line, you get it. And it's one of the more accurate indicators I have. It's not an exact timing indicator. It's sort of like divergences. It works hand in hand with those. In other words, sometimes it's one and done. Here's an example of a one and done. We tagged, we hit the red line, and there shortly after a drop came. And these are all at least 8% drops, sometimes more. But you can see down here, we hit the red line, yellow line. We kept going up for a little while. And so really the bottom line is I've seen this indicator last just days when it was hit, and I've seen it go as far as months, but I don't recall, and you can look at it, many instances where you got down to that low volume and a correction did not follow. This was the longest period right here of prolonged or extended low volume right there, leading into what of course proved to be one of the biggest drops. So if there's any takeaways from it, typically, but not always, the bigger it is, the bigger the drop. That was the big drop in the COVID lows. And again, that was a big drop. Fourth quarter of 2019, many indexes fell over 20%, and those that didn't came very close to it. And it was again foreshadowed or preceded by that drop to that level. So there it is. These are all the corrections and even bear markets in the last several years, and they were all or most at least, signaled. There's one where we had some persistent low volume and it didn't result in much of a correction. I'd have to use candlesticks to measure the exact drop. That sometimes these line charts don't do it justice, because when you have big spikes, line charts will only show you the closing price for the day. And when you look at candlesticks, you have a range, and a lot of times you peak on a high volume big candle and then a reversal. Same thing, especially on bottoms. Bottoming candles are usually very large, and you reverse intraday, so it doesn't reflect the scope of the entire move there when you use a line chart. With all that being said, I did point out last time I updated, this indicator was right here, and I said at the time we had it. This is SPY, the S&P 500. We had the low volume triggering here on SPY, but not QQQ. I mentioned that, and now what we've done since then is we've actually crossed down below the yellow line. I don't know. I think you can see it here. I'm going to zoom that in again. We're way down there. That 10 EMA, excuse me, exponential moving average on the volume is well below that yellow line, and I'm going back. I don't even see that happening. This is the first time that's happened. So that's something. And more importantly, okay, so the SPY had triggered that recently, but at the same time, when I did that update a couple months back, QQQ was not there yet. And so here's QQQ. All these arrows mark the tops when the volume indicator was hit. You can see I color coded them here. If you have a red arrow, it means the red volume line was at the upper line, and then boom, correction. That one was, and I put a little note here. We came close. We might have reversed just above it, but it was right after major correction. So by the way, when you finally get the signal and you get a big drop, you want to wait a while. Again, you want to see at least somewhat. It doesn't have to be a super extended run, but you don't look for another signal right after a big drop. And again, that was it might not look like much here, but that was a nearly 20% or so drop right there. And there it is. So you can see all the arrows. More often not work. That was an extended period of low volume, followed by I think the S&P 500 fell 36%. QQQ might have fell a little bit less. Tech held up during the COVID, the initial drop back there. Here was a period, and there was a decent correction right there as well. And boom. So this is my update. We now have it, you can see on QQQ for the first time since this drop back earlier this year in QQQ. And to measure that drop out for you, you go to a candlestick chart, and that was in the beginning of the year. And so from high to low, if I grab that candle, that was the biggest drop that we've had in actually the second biggest drop since that big drop back in the first quarter of 2020 when COVID first really took hold of the markets. And that was about a 12% correction. I just measured it there. So that's it. That's all I wanted to share. Again, it's not an exact timing indicator, but sometimes you get the signal and that's it, one and done. And other times it can take months, and I'll just end it with this, like every indicator, there's nothing 100% effective. If there was, this would be easy. We'd use that indicator day in, day out, even if it took a year to come, but it's not. So, I did show you the history. You could glance at there. More often than not, or at least historically, it's been highly effective, at least in recent years. So let's move on. I just want to mention that was triggered. Let's talk about the POS chart. It covered QQQ and SPY, gave you those levels, little minor trend line there. And then IWM. I haven't talked much about the small caps because they've been just grinding around. I'm on a 60-minute time frame, but you can see going back and forth. But there's some support here, and if you look at the volume at price histogram, that's these green and red bars here. You might not be able to make them out on the video depending on the brightness of your screen, but there's quite a bit here, and it only makes sense that over the past, goes back to the beginning of the year right here, almost actually all the trades in IWM, the small caps, have been here. So a lot of people buying there. And like any trading range, this works like a coiled spring. It's the small cap index building energy. If it can break out to the upside and hold that breakout, that's bullish. That's longer term bullish. However, a downside break is quite bearish, and you expect usually you'll see a pretty big move, and so an upside or downside break of that range will most likely determine the next trend. It's not a super well-defined range. What I mean by that, the bottom of it, we got a couple, spikes in different places, so it's a rough range. And zooming down to the 60-minute charts of the future, well, that's 60-minute chart IWM right there. This is what it looks like on the daily, and again, you can now clearly see the range when I go to daily. This is it. So the small caps have stalled out and in the entire year. This was the beginning of January right here, and they entered that range. And so now you can see that support shelf really right there from the daily. I have the lower line at about 208.50. Upper line would be roughly 234 right there. And in the 60-minute chart of the futures, RTY, your small cap futures, right here, you had a little minor trend line that was recently broken. But again, I don't have clear levels. You see some lines. This resistance zone is pretty good, up to about 226.50 or so. But on the downside, we don't have very good support. This trend line was the best line I had, and that was just recently taken out. So kind of sloppy there. But again, based on what I just showed you, the divergences building on the indexes, which have been going on for a while, and finally getting that low volume signal on QQQ plus SPY dropping to levels that I haven't seen in years on that 10-day moving average, I'd say the case is getting stronger and stronger every day, and especially at this point in time. And I'll maintain what I've said for a long time: the risk reward still skewed to the downside despite the uptrend. People get confused by that. Yes, is the trend bullish? Yes. Is risk reward favorable to go long here because of that? Well, trend chasers will say yes. Based on my indicators, I say no. And from these periods of prolonged low volatility and extreme bullish sentiment usually come pretty big moves. So I would not be surprised to see the next sharp correction, even one of those mini crashes that we've seen in recent years. Is just a side effect of the Fed's bubble, pumping liquidity in this market. Hedge funds and individual traders, especially retail traders, all on one side of the trade, and when all of a sudden when the music stops, crowded rush for the exit. So just act fast if you start to see these levels get shattered that I've covered. All right, let's get off the markets and talk about credit spreads. I'd mentioned these on Friday, talked about junk bonds, pretty extensive update in that video. And I followed up under that post, and this is what I'll often do. So when you get the email alerts, I encourage you to come into the site, click the link from those emails that you get. It'll take you to the site, take you to that post if you're already logged in. And I posted this chart. And then what this is, you're looking at credit spreads. Let me dismiss that message. This is Fred. You can go to this. The website is fred.st. It's the St. Louis Federal Reserve. And you can Google their site. I could read you the whole URL, but it's kind of long. And what I look for, I have a couple graphs. You can create a free account, and you can replicate and save these. There's different high yield indexes. This is one of several I use. The ICE Bank of America U.S. High Yield Index Option Adjusted Spread. So it's really showing you that spread between investment grade bonds, treasuries, i.e. treasuries, and junk bonds. And then you have the S&P 500. And typically they're going to move inversely. When the stock market is correcting, the S&P, obviously credit spreads are going up. It shows increased risk of default. When the markets fell off a cliff during COVID, credit spreads shot up. Junk bonds were rapidly deteriorating price, factoring in the higher probability you'd see a lot of defaults in the junk bond arena. And so the takeaway here is I look for divergences, and that's what we had. This is down below. Again, this is the credit spreads. And then the S&P is in red. So the S&P was still going up, had a little blip, kept going up into the highs. Was it late February, I think? And at the same time, you were seeing credit spreads rise. So here it's not divergence, it's convergence you want to look for. Divergence are when two things are moving apart, and normally you see that. If the stock market is rallying, it is indicating future economic growth expectations are bullish, obviously, and therefore the risk of junk bonds will typically fall. So that's why these two move in almost perfectly inversely over time. And again, you want to sniff out those divergences. And so I did point out the other day, there it is. Credit spreads have been moving up recently while the S&P 500 is going up. So there's your convergence. You know, as I said in that comment section below Friday's post for the video, I just made a reply this morning to somebody there that, look, it's something to monitor. It is not a hard sell signal, just like my volume indicators and divergence. But when you get what it is, I look at a lot of different things. And so I have, you know, for a rally or to reverse after a bear market or a correction, I look for check boxes. And those be, and in this case, after, you know, a rally here, I'm looking for a reversal downtrend in the check boxes. For a correction would be negative divergence, low volume indicator, a lot of things. I follow a lot of stuff, excessive bullish sentiment. And here's how it works. It's simple. There's no 100%. The best thing you can do is look at when you get enough check boxes here, a lot of evidence. It's like I always use the analogy, you know, prosecuting a defendant. You know, you're innocent until proven guilty, and the prosecution has to pretty much present an overwhelming case. The stronger the case, more likely conviction. Same with going long or short a stock, whether it's an individual stock, the market. And so the more check marks you can have to build your case. I like the stock. The fundamentals are good. It's got a high short interest. You might say that's bearish, but no, that can be bullish for a short squeeze. Bullish chart pattern, you know, volume patterns, et cetera, et cetera, et cetera. And so that's what we have. We have just another checkbox today with that low volume indicator being hit. Sentiment's already been there for a long time. That checkbox has been checked, excessive bullish sentiment. And now we also have credit spreads starting to widen. Yet it's not really reflected right now on the JNK and HYG, the junk bond ETFs. So I'm always looking for those clues. That's what everyone's doing in the markets, looking for an edge, things others don't see. And you know, it doesn't take a genius to tell you we're in a bull trend. So if you want to, you know, go long, you just buy long and hold with stops in place. That's not my trading style. I'm looking for turns in the market and the bigger moves. Okay, so now moving on to the next, well, same topic, related note here. This is the watch list I gave you last week that I created, and it has the top holdings for those two primary junk bond ETFs, JNK and HYG. So you can see here today we have the majority of those holdings are down. Again, this is a combination of the top 10. Some had overlap between those two ETFs. You know, they're two different junk bond funds. Some of the holdings were the same, some were different. So again, it's a combination of the top 10 on both. And you can see, you know, quite a few. Most are down today, and some are down pretty good. I've been, you know, one of my, you know, the trades I have the most conviction on right now, biggest positions short on crude and you know, Occidental Petroleum. That's a big holding, down almost 4.5% today. Caesars Entertainment, you know, not, you know, is it good for the casinos? Delta variants really ramping up. You know, ERs are at capacity down here in Florida and elsewhere in some places. So no, that's no good. The Carnival Cruise Lines, again, these are companies that at least these two and this one also will be affected by the path that coronavirus takes. And hey, maybe Delta variant all of a sudden just starts to dissipate, go away. Everyone's good. We have herd immunity, but the charts are the charts. So oil, we don't have to have you know, coronavirus flaring up again to make a bearish case for oil. It just helps. It gives a tailwind to that short trade, and it gives a tailwind to a short trade or a bearish bet on, you know, casinos, cruise lines, airlines, etc. So that's just want to mention that. Now, with that being said, you know, I don't read too much into any one-day price action. Just like I said earlier in the video, I don't read too much into a single day, you know, high volume or low volume. It's more of a trend, and also, what does this mean? Okay, a 5% drop in Oxy or any of these stocks here. Let's talk about that. Let me pull up these charts, and let me do one thing. Okay, I needed to drag that list over to another monitor so I can click on it. Okay, so takeaway from that, okay, 5%, now 5.32. Okay, we're falling. Um, but it's noise unless it occurs with a significant technical development. So that's what I'm watching for on things like Oxy and all of these. I take them in. It's not just any one. This one could break down. This one could collapse. And but if the rest of the holdings in those junk bond ETFs are holding up, it's not going to have much of an impact because they diversify like any mutual fund or ETF does. That's the benefit of buying those. That's why most people, most especially retail investors, are going to buy a junk bond fund or a treasury bond fund or a stock fund or ETF because of the diversification. So now what I'll look for is, are the majority of these falling, and more so, are they breaking down? What does that mean? Well, we have support. There's a little minor uptrend line there, right there to watch. I have a support level at about 2460. That's very important to me. Very significant level. Big reaction high back here. I also have, as you can see here, the blue and the red lines are the 200-day moving averages. So you have the 200-day simple in red right there, and here's the 200-day exponential moving average in red, and the simple in blue, and they're both right below there. And basically, with most stocks, not all, you got to look at every stock on its own, but with most stocks and the indexes, there's a lot of trader. I'd say that's probably one of, if not the most popular series of moving averages, the 200-day. And some people use exponential, some use simple, and hence the reason I use them both. Because if half the eyes are watching the 200 exponential and the other half are trading and watching the simple, I want to see them both get taken out. And typically when a stock is above them, they Oxy regain them or move back above them here, it means the trend is bullish. And once above, they often act as support when tested from above. But when they break, like right here, they broke back. Actually, they were already broken. Let's roll back. Here it was right here. If you go back, and hopefully you can see those lines on the video, right here, we were in a bull trend. We're holding them up, tested support. Right here, both of them, the 200 simple and exponential, they came in together. They were pinching together. They were taken out. That was a sell signal. We took out the 200 exponential and simple, Oxy did, and back tested. It was in a bear trend, and then every rally back to those MAs, either one or both, like right here, a perfect test. That was a perfect test, rejection. It kept the bearish trend intact until this point right there, and then we recovered them. So bear trend, bull trend, simple stuff, right? At the risk of oversimplifying it. And so here we are. We're coming up. We're testing them. We tested the 200 exponential right here and held it. We had a near test there and held above it. So that's what I'm looking for. And I'm kind of getting long-winded here, but this is what I look for, is if this one solidly takes out that 2460 support and both EMAs, and it takes it out on a daily closing basis, especially a weekly closing basis, so it's not just a whipsaw, then that puts this one on a new sell signal and tells me most likely it just started or it is now in a new downtrend, a primary downtrend. And the more of that you see with all of these stocks that I have in here, there's Caesars Entertainment, CZR, look at that, right on the 200s, both of them pinching together. It's been holding so far, bounce, and we're there again. So this is what I'm looking for, and we've already broken trend line there, so there's a sell signal from that perspective, and we're in a near-term downtrend. And then again, I take these collectively, all of these, and if I see the vast majority of these top holdings breaking down, I know the junk bond market's in trouble, and the Fed can buy all they want, but that's not a good sign if these stocks, the equities for those companies, are breaking down. Carnival already were down below. Back here, we were below the 200s. Had a brief recovery there, couldn't hold it and rejected. Stayed below. Gained them right here, regained them above, at least above both of them. But now we're below both of them. You can see we're zooming nice and tight. There's the 200 exponential and the 200 simple. And we have a primary trend line here. So now this is the level I'm looking at for Carnival. I've got big support here, about 1932, and a primary uptrend line. So if I see this and something similar, I'm not going to go through all those holdings now because I just did it the other day. The more I see of this, the more likely it is the junk bond market is about to drop substantially, and that's going to be a red flag for the market. It's showing you're going to see a spike in defaults, and or at least again, it's not even if they default, it's the uh, expectation, if you will. Remember, the market looks out 6 to 9 months ahead, so you don't have to see those defaults. If the hedge funds and institutions start selling, the equities are falling, then there's obviously problems with the company, and that's going to be the same with their bonds. Okay, so as of now, we're starting to see, and we have seen recently, some cracks, divergent highs, and everything else, everything I covered. But there's still some support levels and still some things to go. So that's it on the junk bonds. I'll continue to monitor that and provide updates on any significant developments. All right, let's move on. Let's look at crude, natural gas, gold, and then we'll wrap it up here. Crude oil, CL, these are crude futures. This one has been a short trade and will continue to be. I've kind of mentioned it as more of a long-term swing short with also your trend trade on the downside. I think there's a lot more downside to come in crude. And it can also be a swing trade if you're an active trader. There's been little patterns within here, once you fell down, you hit all these targets, support levels, you bounce, rally back to resistance. A little negative divergence here on this bearish rising wedge breakdown. That was another sell signal. Targets or support levels hit, bounces are likely. So again, you can actively trade this or position trade it and be short and stay short as long as this remains intact. We are in a downtrend. I mean, it's been crude as volatile. Charts sometimes are sloppy, sometimes it trades perfectly to the technicals, but long story short, this is a downtrend. So far, we've rallied, counter-trend rally, got sold down, counter-trend rally. This is a big level. We've hit it several times, $65. Once that goes, that's going to be bearish. And if it goes soon, we're not going to have divergence here, at least not on the RSI. There's some potential divergence on the PPO, but the PPO is headed straight down. And so again, this is a big level right here. The bottom of that $66 to $65 support zone, and I do expect it to get taken out and go. And then if it goes, there goes the energy stocks. That goes without saying. XLE, XOP, companies like Occidental that I showed you. A good percentage of energy stocks, oil and gas companies are their debt is considered junk bonds, below investment grade. It's just the nature of that industry, which has been in decline for well over a decade now. And natural gas up next. This is on UNG, the one of the more popular ETNs. Big resistance there, up around 15, 14 and change, up to about 15. That resistance level we hit, and then as mentioned, we recently took out the uptrend line as well. And there's a little snapback rally today, but I still see more downside in the near term on the swing trade for NG. This is NG natural gas futures. You can also use, I think it's QG for the mini contract if you don't want to use NG. Trades on the same price levels. There was our divergent high recently right there. We had a little minor support right here that was taken out, back tested, came down. We reversed just above. These were all targets. All hit 3,856, 380, and then 374 roughly, and then this uptrend line, which I still favor being hit. And so we reversed just above that 380 support / target so far. Looks like a counter trend rally. Objective shorting op right now if you covered on that level by chance. A little reaction high there. And I still favor one more leg, at minimum one more leg down to this uptrend line, and or that at this point, if we get another leg down, then that 380 will probably come in again as support right there. We reversed again just shy of it today. So there's a little potential downtrend line too that might check it. So probably one more leg down. It's pretty decent support if we overshoot the trend line about 374. And should that go, I don't have support until all the way down here to 357. So if you're, want to go for more, you need to see this get taken out, but you can of course set a stop and trail it down and let it run, and that's the nature of natural gas. When it, you get hold of a trend, if you can hold on to it without getting shaken out. What I mean by that is this is the most volatile commodity that I'm aware of. There might be others out there that have bigger price moves. Lumber's up there with that, but from day to day, natural gas can swing, and I've seen it gain or lose 10% a day. So what I mean by getting shaken out, you need wider stops, smaller position sizes, and it's worth it if you take a smaller position size because you're swinging 10, 20, 30, 40% on these shorter term trends that can last only a few weeks, couple months. And so that's to me the key to staying in a trade and riding out the zigs and zags. If you're not a very active micro trader, in and out all the time, is to give it a little bit of room, and then that way if it has a you're giving it a 10, 12% trailing stop because you're shooting for 34, 40% on your move, you're not going to get clipped out on these little daily pops and drops of 2, 3, 4, 5, 6% or more. Okay, and gold still, well, back out of the buy zone now, actually. This was has been and still is the buy zone for longer term investors and traders. And we had two tags at the bottom. This little dip back into it came about halfway into the buy zone, and so far we've moved back out. And so near term gold's rallying. It did so. Let me add some lines here because I didn't have these in there before. Not on the RSI, but here on the PPO, we had divergence right there at that on the daily chart. And so far that divergence is playing out for rally. 60-minute chart of gold futures. Let me cue that up for you if I can find it. Here we go. Pretty sharp reversal. Yeah, I don't know what this was. Well, I do know what it was. It coincided with the breakout in the dollar, or that pop in the dollar broke resistance and drop in the euro. But it looked like a washout move here, and boy, we've recovered all of it already. So pretty strong snapback, and so maybe even a bear trap. For those that shorted gold on the way down, on that big drop. They're now underwater, most of those, unless you hit it right there. And that's where, if you were long as an active trader, that's where a logical stop would have been placed somewhere in there. But either way, some rallying back up, and we'll just leave these same targets from the previous trade. If you're, if you were in that and held on or jumped back in or whatever, T1, T2 was hit. There's T3, T4 right there. All right, and as mentioned, the dollar had that beautiful bearish rising wedge pattern there, broke down, was moving down. There was the pop. That was the resistance line that was taken out that day that gold broke down, had that sharp move down. It was that final thrust up in the dollar that pretty much made a slightly higher high and just simply extended the divergence that was in place at the top of the bearish rising wedge pattern. So I'm viewing that as a counter trend rally, and probably headed down quite a bit more, and if so, that's going to be bullish for gold. And likewise, whether you're trading the euro or you use it to kind of get a gauge on where gold's going, there's our downtrend line. There's the divergence. We had the divergence in place there. Euro was rallying but failed to get through that resistance, dual resistance, the downtrend line in that 119.15. So that rejection there coincided with that thrust down in gold. But again, all it did is just took the divergence that was already in place and made it even larger. So if we can pop the trend line, rally up to 119.15, if we can pop that, all the better, because that's pretty solid resistance right there. And that would be quite bullish for the euro and quite bullish for gold if that happens. And there's your potential swing target right now up there at about 121.12. Okay, let's wrap it up here. So it wouldn't be too long a video, a little bit over 30 minutes, but packed a bunch of stuff in there. So those are the things I'm watching. This has been Randy Finney with Right Side of the Chart. Have a great day.